Hi, if you're new to investing or simply want to improve your investing knowledge, well, hope you're in the right place because these videos and this channel is about improving your financial knowledge so you can reach your goals in the future just like me. Now, I've applied the principles to become a net millionaire in my early 50s. Now, let's dive into this video. Now, this video is about my stocks and shares ISA review for November 2025. Now, it's not to boast or brag or say, look at me, but to give people hope. If I can build a portfolio of six figures, you can too. If you think long term, create an action plan within a tax-free offer. So what are the aims of the portfolio? For annual growth of 10%, for dividends this year, £5,000, and a year-end fund value of £153,000. So let's see how we've done the other month. Well, we started at 176,050, we finished at 177,727. So a profit of the month of £1,670, year to date 32.26%, so well above expectations. Look at the following graphic. We put contributions of just over £1,200 in a month. So we put 5473 tax year to date. We are putting on a regular basis, so we say drip for the money start of the month. And our platform provided charges fees of £22.03 based upon a portfolio of our shares on our funds held within the portfolio. Again, let's look at the column graphic of where we're actually held. So we held nearly 59% in UK and Europe, 31% in Americas, and 10% in Asia and emerging markets, so well below the benchmarks of a, shall we say, all-world index, but it's what we're happy with. During the month, we only received one dividend from our passive adventure fund. We reinvested it as accumulations, but it was £65.49. Across our shares, we've got a yield of 4.77%, but year to date of £4,682, so £62 better than expectations. So not a great month, but look at the start, we've had some very good ones, and we will finish on a high in December from some quarterly dividends payable. And let's dive into the portfolio. Now, these are my own personal opinions. I've got no reason to always sell to selling the shares in the foreseeable future. At the moment, we own 10 shares, 10 in profit, none in loss, all UK based. 48% of the portfolio, of which 43% in the FTSE 100, 5% in the FTSE 250, but total shares of worth nearly £86,000. Now, our major holdings, shall we say, in banks, financial services, what we know about, comfortable with. Our largest holding is Lloyds, just over 21,000 shares, £20,000, 11% of the portfolio. Very good result, shall we say, has a very good result back to the budget, and it's nearly at a magical £1 limit of a share, but it has been a very good, up 70% this year. We own Aviva, the insurance company, 2,208 shares, £13,000, 7% of the portfolio. Everyone needs insurance. Got a nice yield of 7-8%, we just switch off. We also own L&G, Legal & General, 5,601 shares, nearly £14,000, 8% of our portfolio, but a much better yield of nearly 9%. We own NatWest Group, 1,282 shares, £8,000, 4.5% portfolio. The shackles are off, now got a free reign, and the dividends are returned around about 4 or 5% yield. We own Barclays, 1,699 shares, £7,300, 4% of our portfolio, and again a yield around about 4%. And then finally, shall we say, away from the UK banks, HSBC, 558 shares, nearly £6,000, 3% portfolio. Had a great run lately, but very poor results because what's happening, shall we say, in Hong Kong. But it does pay a quarterly dividend, and it is going for a restructuring plan. Away from the banks, we own AJ Bell, the platform provider we use. 991 shares, £5,500, 3% portfolio. Very cash rich is what we see in the growing company. Assets under management growing substantially. New customers growing, shall we say, through the platforms, through Google, through advisors. Back onto the insurance companies or the pension providers, we own a company called Phoenix Group. And they own multiple companies you may not have heard of. Shall we say, Standard Life, Reassure, Phoenix Group. 688 shares, nearly £5,000, 3% portfolio, but a very nice yield of nearly 10%. But it's what we know about, but it's good steady premiums, shall we say. It's based on pensions, what we know about. Away from the banks, we own Card Factory, 4,114 shares, £4,000, 2.2%, has struggled recently, is very cash rich, but affected by the high street minimum wage, cost of living crisis, but it is expanding, shall we say, away into online presence. But dividend increase, very good results recently. And then finally, Sainsbury's. We own 922 shares of the retailer, nearly £3,000, 1% of the portfolio. Hopefully good results, shall we say, soon. We'll pay a dividend, shall we say, but in a price war with other companies. But it just goes to everyone needs food. So a nice collection of shares, probably financial shares, what we know about. But the banks and, shall we say, insurance have had a great run this year. Hence, the reason why the portfolio is up 30% plus. We're not going to get everyone right, but they've been there for numerous years. They'll still be in future. They'll have good ones, they'll have bad ones, but we just switch off and all the dividends reinvested within the portfolios to grow future assets in later years. Now let's look at the funds held within the portfolio. At the moment we own 8 funds, 6 in profit, 2 in loss, 52% portfolio, so slightly better percentage, but £92,000. Now we are trying to simplify our funds away from active to more passive. Our largest fund is a passive ventures fund done through our platform by AJ Bell, nearly £28,000, 60% portfolio, and it did pay a dividend in the month of £65 reinvested. We own a Fidelity World Index fund, £27,000, 15% portfolio. We did top her up £12 a month, own, shall we say, several hundred shares, double valuation, but a small yield and very low fees of 0.12%. We own an LNG Technology Fund, £22,000, 12.5% portfolio. Has had a good run lately, who knows what will happen in the future, but it owns around about 250 stocks, mainly US based, slightly higher fees of 0.3%, but the tech sector's had a very good run lately. Now some funds have struggled recently. Fidelity China Fund, at nearly £3,000, we are showing a loss, 1.7%. China's been good this year, but not in previous years. It's struggling. Now, when we're back in profit, we're going to leave that fund for obviously reduced costs. And another fund we're going to reduce is our emerging market funds. We owe nearly £1,000, thankfully it's 0.5% portfolio, showing a very small loss, but when it's back in profit, we're going to take the money within active funds and put it into our passive funds. For one, to reduce the fees, admin. And we own a Russia fund. We put £500 in, went to £600 plus, struggled ever since. Now at £314, but thankfully it makes up 0.18% of our growth. But it just goes to show we picked a company, it backfired. You're not going to get everything right, but thankfully it's a tiny percent of our portfolio. But who knows what will happen? Will the Russia-Ukraine conflict ever be settled? 2 funds were ring-fenced, shall we say, for big favours. We didn't want to add to existing funds. We just picked 2 simple tracker funds, just switch off. We put £3,000 in an S&P 500 fund. It's now worth £3,900, 2.2 portfolio, but we didn't do it to add to existing holdings. We want to ring-fence the money. And finally, an FT All World Index fund. We put £5,000 in. It's now worth £6,600, 4% of the portfolio. But it was done for a reason. We didn't want anything done. But it just goes to show you're not going to get everything right. But what we've proved recently is our passive funds are outperforming our active funds, much better scenarios for much less fees. So whereas our shares are going to keep existing holdings, our funds we're going to reduce and simplify them over the future. But what we sell, diversification. It just goes to show something. If I can put a portfolio to over 6 figures, but it's going to take time. It's not a get rich quick scheme, but you will get there if you invest on a regular basis within a tax-free offer and you think long term. So use the tools such as the stocks and shares investment product. Remember, like videos, smash the like button, subscribe to the channel, and we'll see you again in the next video.